before we had the 2008 crisis, there were people who were screaming, hey, there are a lot of risks right now that you cannot see. I think that's what we're seeing with shadow banking, right?
Just interesting, even last week, how differentiated we had the banks sort of in performance and in results. Your big banks gave their Q3 results, and they were all blowout. I mean, just fabulous. The most money they've ever made, ever. And a part of it's trading. A part of it is increases in deposits. I mean, they've made money everywhere you can make money. That's the big banks. The regional banks hit the wall last week, hemorrhaging in the regional banks, in part because you had a couple who discovered fraud in some of the loans that they made. The banks were not committing fraud, but they were subject to fraudulent activity,
behavior inside.
And so now they have to reserve a lot more than was expected. So I mean, we had some banks down 12, 15% at their worst.
They were regional
last week, regional banks. Yeah. But then the shadow banks. So you've got the differentiation between the big banks, and frankly, the IMF report was pointing to how strong the big banks are. They're doing very well. Their balance sheets are strong. Their liquidity is high. Their leverage is low. But the significant chink in their armor is the interconnectedness to non-bank financial intermediaries.
Which shadow bank?
Yeah. The NBFIs, the non-bank financial intermediaries, easier understood as shadow banks.
There you go. Another abbreviation that we have to learn, right? Yeah.
NBFIs. You won't forget that.
Of course not.
So read that as the alternative asset purveyors. A part of the IMF's critique here is that they're looking down the road. No issues today, but you've got tons of inbound volume into these alternative asset purveyors. So the asset classes are performing well, but liquidity means very limited on the other side. If it wants to go the other way, it really can't. So you've got private equity, you've got private credit, you've got hedge funds, you've got different specific financial products, collateralized loan obligations, leveraged loans. That starts the list of leveraged risk assets that are, I guess you could describe it as being remotely financed by the big commercial banks. They're not directly or entirely held on their balance sheets. So in question by the IMF is, how do we get our arms around the daisy chain of exposures?
Right.
Because there's something going on. There's a long discussion of these assets increasing risk in pension funds, in insurance companies.
Well, see, that's what I was thinking. Remember AIG just caught everybody off guard back in 2008, and it had to do with similar types of vulnerabilities.
Yeah, and I mean, we've highlighted the insurance company exposure, and we've talked quite a bit about private equity firms going on a spending spree for insurance companies, to own the insurance companies, to gain access to as much as $8 trillion in insurance company assets so they can dump the deals they've been unable to take to market in another form.
Make them bag holders.
Yeah. But it's long-term capital. So you are, again, $8 trillion that's sitting there to be invested. Nobody's going to dig for bodies for a long time. I mean, this is like the perfect field to bury bodies.
Here you go. Here, buy this. Yeah.
The back 40 in Nevada. That's the insurance company dumping ground. One of the concerning aspects of the shadow banks, the NBFIs, is the lack of visibility, said differently, outright opacity of their balance sheets.
Right. They can't see it.
Inside insurance companies, and to give it sort of the stamp of approval, this has a ring to the 2005, 6, and 7 period where credit rating agencies would say, yep, looks good to me, and move it on down the road. Well, in this case, they're not publicly available ratings. They basically say, trust me, we got this, we looked at the numbers, and we give it our signature. You're good.
Yeah. Yeah.
Not publicly available. It's outside of the realm of scrutiny. How do you think that's going to play out?
And yet these are assets that cannot be liquidated in normal markets.
Oh, that's right.
At the price that they're claiming they are.
That's right.
Yeah.
But they can be carried on the book at whatever you want them to be. Right. So you've got a time bomb ticking in the world of pensions and insurance companies because of this mashup. And again, the IMF report is saying, look, commercial banks do own a sleeve of this. There's some exposure. They've offloaded most, and it's been repackaged into structured financial products that can then be placed in these portfolios. There was a Financial Times contributor this week who described this as a form of capital arbitrage. Credit risk being moved from bank balance sheets, where you've got heavy regulation, to unregulated shadow banks. Banks keep a small slice of exposure, pass the rest on. That was the best article I came across this week. Title of the article, "So Much of Credit Securitization Still Relies on Magical Thinking."
Yeah.
It dovetails perfectly with the IMF report.